Barclays Africa has acquired a 49% stake in RainFin that gives peer-to-peer lending a huge boost into the mainstream of the financial services sector here in South Africa. Sean Emery, the Chief Executive of RainFin, is with us in studio. Sean, we were talking 2012.
I know.
And
June 2012.
And now I see it. I was going through my emails actually before we got here, and yes. I loved what you were doing, but unfortunately my board of directors at the time thought the risk was too high. Well, you've shown them something, haven't you?
Well, I think that's the case that we're getting. Whenever you change an industry or you try and change something, you're always going to get people that are concerned with what you're trying to do. So managing risk is a big part of what we have to do. I think over the last 2 years as well, I mean, we learned a lot as well. We also went through a lot of people coming at us and challenging us, and the regulators and the institutions, and it was difficult to prove to everybody that what we were doing was actually for the benefit of the individual people, the borrowers and the lenders. It might not be to the benefit of all the institutions, which is maybe why we got so much flack, but it definitely is for the benefit of all the individual people.
We'll talk about your business in a moment, and also the deal that you've done, which catapults you into a different league. But what kept you going through all these difficulties?
Well, I suppose tenacity. I mean, we had to believe in what we were trying to do. At the end of the day, you know, for the last 10 years, I've been involved in these disruptive technology businesses. Some of them take longer to take off than others, and ones when you take on a whole industry tend to take a bit longer because you get some pushback. It's much easier in the US or in markets where there's a lot of people who are early adopters and first adopters. You know, South Africa doesn't have that. And so you really have to have a lot of belief in yourself and a belief in the team members around you. And what was really great was that although we did knock on a number of doors, which you said previously, everyone we spoke to was quite encouraged about the business we were trying to do. So that encouragement, you feed off that, and of course your family helps you a lot, and in the end you have to power through.
So this deal with Barclays Africa, walk us through it. How big is it, and what does it mean for your company?
Well, for our company it really is that. I mean, it pushes us into the mainstream. A lot of the resistance we were getting with peer-to-peer lending was people asked us these questions. They said, well, if I invest in your platform, is my money safe? How do I know that you know how to do credit scoring? How do I know that your organization is meeting all the regulations? You're not going to get closed down, and I'm going to lose all of our money if you guys disappear into the moonlight. And all of these things, now clearly when we go through this technical and financial and legal due diligence that an organization like Barclays put us through, it should really calm the fears of people to utilize our service. It also exposes us a lot to some of the financial institutions who give us the funding to keep us going, which is obviously very important. And also they themselves can help us. You know, when we look at our credit scores, they've got deep history of credit scoring in South Africa, and they're able to give us a lot of support in how we construct our credit scoring, so we can hopefully give great returns to our investors.
Real basic stuff, peer-to-peer lending, explain it.
In its very simplest form, we take people who have money and we give it to people who need money. So these are borrowers and lenders, and we try and connect them in the middle. Banks have been
through the internet.
Through the internet, right? Banks have been doing this in the past. Clearly, they've been taking money from people who want to lend it, but they've been taking it, repackaging it for themselves, and obviously lending it on and making a big margin. Our business is not about the margin. We give the margin to those two people, the lenders and the borrowers between, through the platform. So we drive out a lot of the costs, we drive out a lot of the leverage in the model, and therefore actually the returns that go back to borrower and lender are much greater than through the traditional banking.
Do you know, it was interesting, I was going through the detail of the Standard Bank results yesterday, and their interest margin is the highest it has ever been, their net interest margin. So there couldn't be a better time for you to come into this market.
Well, really, I think that interest margin is very appealing for people who believe that they would like to enable people that need money as well. So you've got financial institutions on the outside, you and I, individuals, pension funds, who say, well, why can't we have some of that margin? Why is it only the banks that have access to that margin? And the reality is that we can give that to them. We can take pools of borrowers, put them all together, and we can obviously allow them to have access to this lender group.
So often we talk about entrepreneurs in South Africa and the lack of funding that they receive. So I take it this could also potentially boost that industry in South Africa.
Well, very much. I think, there's two contexts here. We need to understand, are you talking about the fact that our platform could help new entrepreneurs to get new funding? Yes, we definitely are launching an SME service. I definitely believe that our SME sector in South Africa is dramatically underfunded. That's because I believe the banks have been looking at them in the wrong way. They've been looking at them from a balance sheet point of view. They haven't really been looking at them from a cash flow point of view and from a detailed analysis. So part of the new services which Barclays is going to give us the ability to launch will be these SME services, where we can take different models and add them into the credit score. For example, procurement data. procurement data for us is such a great indicator of a company's success. If someone's got 5 outstanding invoices, they're billing, they've got recurring revenues, they've got contracts, they have managed to become suppliers of the really large organizations in South Africa, that guy deserves funding. Even though he might have a very sort of asset-less financial statement, he still has the cash flow to support funding. All consumer lending is done on cash flow, right? It's done on a pay slip. So why can't we do cash flow-based lending to businesses as well?
But you're doing both then, consumer lending and...
At the moment, our service is just live with consumer lending. But yes, we have 7 products which Barclays now give us the ability to launch. They give us the funding to launch those. From operational capacity, we are able to launch ones in SME focus. We'll also launch some in corporate bonds, which are going to be very interesting. And we're also going to launch some fixed asset support ones as well.
It's an incredible jump for you, Sean. How did you manage to get Barclays Africa? Because has any bank in the world made a stake in it?
No, ours was the first. This is the first transaction in the world that a bank has done.
So you must have, I mean, Maria must have something going for her if she's thinking in that way.
Well, I think what's very interesting is inside that business, the Barclays business, there's this unit which they've established, which is now called the Growth Unit. It's headed up by a guy called Eugene Boyson, and there's someone there called Johan Locke who works in it. And they've got a very good vision about these things. So yes, you talk about those doors I knocked, and I went to lots of individual doors. But when I had a conversation with this group inside what I thought might have been, traditionally perhaps an older type banking environment, but they got it and they saw it, and they're very supportive of it. And since then, all the conversations with the high leadership, Stephen van Coller, the conversations even with Craig Bond and them, all in the organisation, they get that this is where the market is going to go. They don't know where, and they're allowing us to be, they bought 49%, they want us to go out on our own, they want to support us as much as we can, but obviously it's a subsidiary investment, we're not consolidating into their business, we're sitting outside and we're able to have the freedom to do what we need to do. But it's very nice.
Did you talk to the other banks?
Yes. I talked to the other banks in a slightly more generic way than the conversations were with Barclays. The other banks have got slightly different views on this market. The answer was yes, we did.
Well, well done to you. Well done to Barclays Africa for... You know, it's funny, these are the little things that happen that you see in these big organizations that tell you that they are transforming, that they are changing. And for this kind of investment to have been made in the first place by a Barclays Africa, by a big organization, tells you how the culture is changing there. And
well, they're taking a leap of faith, which I think is very interesting as well. They're also going a little bit into the unknown. They're trading into something which is a little bit uneasy. But there's so much in the pipeline there. You know, when we have a look, when we see the things that they're going to do, I'm very impressed.
Well, I guess it's an opportunity then for Gugu to go and take her family fortunes and back them. Unfortunately, you can't buy RainFin. That's now part of the Barclays Africa empire, or 49% of it is. But you can certainly go and get the top company there listed on the Johannesburg Stock Exchange. And that was Sean Emery, CEO of RainFin. Well, some believe that a weak rand will reverse South Africa's sagging industrial competitiveness, lift economic growth, and redress our unemployment problem. Jeff Blunt, who's the Chief Executive of Cannon Asset Managers, joined us to tell us why a weak rand won't save the country.
I think the misconception comes from the fact that it sounds right. So it feels right that if the rand weakens, it means our exports are cheaper, which means we'll export more. And in fact, what we did is to test that hypothesis. We did an analysis over the last 30 years, and we looked at rands of strength, periods of rand strength or rand weakness, so any changes in the rand and subsequent industrial production in South Africa. And what we found is almost no relationship between industrial production and what the rand does. In fact, there's a slight negative relationship in that when the rand is stronger, industrial production in South Africa does better. So I'll give you a case in point. All-time record industrial production in South Africa was in 2008, when the rand was 7.50 rand to the dollar. The rand now is at 10.50 to the dollar, and our industrial production is actually probably about 15% off. It's not the rand that will save South Africa's economy or industrial production, despite the fact that in some sectors of business, labour and government, there's this belief. It's a misplaced belief.
Misplaced belief, quite certainly. So what are the influencing factors? I understand that global growth, economic growth is one of the influencing factors. If
you try and then decompose it, say, well, what drives our economy or what drives manufacturing, it actually turns out that the biggest single factor that impacts economic growth in South Africa is global growth. So when when the global economy or Europe is doing well, we're doing well. And the reason why is because if the globe is prospering, They're buying South African product, there's lots of confidence, they buy the rand strengthens, and they buy our product. When the globe is struggling, they're not buying our product, there's low confidence, they're not investing in South Africa, and the rand weakens. We're bobbed around by global events, and it's a pity, because these are things that we can't control.
That is quite a pity, because looking at one of the graphs that you had published out, it does seem as though South Africa performed significantly well during the years between 2003 and that 2007, just before the crisis there. And that was in line with global economic growth,
yes,
though.
absolutely. So no, that's I suppose that's part of the point, is that we are driven by that relationship. In fact, probably from a statistical point of view, our correlation, our domestic growth to global growth is about a 0.86 correlation. It's very high. So what we need to do as a country is start addressing the factors that we can control. We can't control global growth, so what can we control in our economy or in our manufacturing mix?
What can we control? Maybe labor, perhaps, from that perspective, and productivity?
Well, yeah. In fact, we think that the most telling statistic in South Africa, if you want to understand the South African economy, over the last 12 years, starting in 2000, real wages in South Africa, so that's wage increases above inflation, are up about 30%. That's a great achievement for a country, because that means rising standards of living, rising quality of life, rising consumer, rising middle class. Now, we all complain and say, well, my pay didn't go up by the inflation rate. Well,
I'm one of those.
But in terms of, from the wage bill in the economy has grown in real terms 30%. The problem, though, is productivity in South Africa, as measured by the International Labour Organization, has gone back 12%, which means over the last 12 years, labour in South Africa is 40% more expensive than it used to be in 2000. We're 40% less competitive. Now, if you want to create jobs and you want to build industry, you need to export. If you can't compete in the export markets, you're not going to create jobs and build labour. We need to close that gap. And there's some near-term fixes and there's some long-term fixes we think that can assist in closing that gap.
I want us to zone in onto a word that you use, productivity. And oftentimes we think that that's getting your farmers to pick more apples or to grow more apples in some kind of way. How do you, work around that word productivity in order to allow South Africa to be competitive in that space?
Look, our view on improving productivity in South Africa, this is not necessarily about corporate South Africa bashing the unions and forcing them to curtail and squeezing workers more. Productivity is a much more encompassing factor. In the nearer term, what we think you can do to try and fix this is start linking real wage increases to productivity gains in corporates. So people will, if they want to get real increases, they have to produce more. Doesn't necessarily mean working a lot harder, it just means working smarter. But the real solution to this is the longer term factors. And that is about changing, first of all, our education system. The way Asia and these Asian countries lifted themselves up is that their productivity gains were in education driven. We need to fix our education system. We're going to condemn another generation of people to poverty if we don't fix the education system. But it's more than that. It's also about, if you're working in a factory and you're getting up at 4 in the morning to get to work by 8 because you're so far from the factory, or the transport infrastructure is not working, that's productivity. If you've got a sick kid and you know that you're going to have to take a day and a half out to get that kid to the local clinic because there's long queues at the local clinic, that's a day and a half lost. So this is a collective issue to fix productivity, and we think that the way you can do this is we need another CADESA. Often people throw this around, but we need another social pact between business, government and labour that looks at all aspects of this. How do we raise, in fact, improving productivity is also about improving the quality of life. So people don't have wasted time in their life in doing unproductive activity. Travel, queues, infrastructure backlogs, these impacted. Education, a huge issue that impacts it. So this is much more than just about having a nastier foreman at the factory who's going to push workers more. This is a collective agreement. We need to get, and we need proper leadership at all levels in business, government and labour to actually seriously say this is what we can fix. The silver bullet for South Africa isn't easy, but it's there. And that is, how do you raise productivity? Well, you do it at a social level, at a management level, at a political level, at an infrastructure level.
Sure, definitely some tough challenges ahead. But if you could rate South Africa at the current moment regarding our productivity as well as our level of competitiveness, how do we fare out of 10?
No, we're not faring well. We're at 3 to 4 at the moment out of 10. Remember, this is also about relative to other countries. So other countries are getting it right. We need to look at countries that have got it right. South Korea is a great example to look at right. Chile is a great example. Unfortunately, we have a preponderance of South Africa to look at countries such as Brazil, so even India, maybe even China, as that model. Understand every country is unique, and I'm a bit nervous when we say, well, look, it works in China, let's bring it here. China's got to manage currency, we should manage our currency down. The dynamics in the countries are so different. If the rand weakens here, we get inflation, pushes up the cost of labor. You don't want a weak rand here because you don't want inflation, because then, so the dynamics are very different. I'm very nervous that we look at interventionist economies as the silver bullet. We need to look at economies where the government facilitates the private sector to create jobs, but at the same time the government makes sure that social services and the social network is intact. And I think that what people confuse on the political spectrum, left and right, is people say, well, if you're left leaving the economy, you have to have high state intervention, and then you can have social services. And if you're right, you can have a market-friendly economy, business-friendly, and no social services. The model we need is one where government facilitates high competitive behavior in the economy to create jobs. So you facilitate a competitive free market to create the jobs. But your government's function is to protect society at a social level. And unfortunately, we seem to think that you have to have a socialist in the economic policy and to protect people. You can actually get the mix right. That's the social pact we need in South Africa.